Good afternoon or good morning to everyone. Thank you for logging in today on our webinar on basics of investing in tax liens. We're going to talk a little bit today about how to invest in tax liens with an IRA account. We have a special guest on with us today, Charles Sells, who's going to share his guidance and his expertise in this field. So hopefully during the webinar today you'll get some great information on hopefully some self-directed IRAs, a little bit about Advanta IRA and what we do. More specifically about how you can invest in tax liens. Whether you're using IRA funds through an Advanta IRA or personally, hopefully you're going to come away with some really good information during today's webinar. Just a note, as we go through the webinar today, if you have any questions for either myself or for Charles, please type those questions into the chat box on your screen, and we'll do our best to get to those during today's presentation. If you are listening to the recorded version online, please just simply jot down my information here. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. But if you're listening to the recorded version, jot down my name, my contact information, and reach out to me after you listen to the presentation, and I can answer any questions that you have. Just a quick disclaimer about Advanta IRA in that we do not promote any particular investments, and we don't provide legal, tax, or investment advice. So the contents of today's webinar are really for educational purposes. We can certainly refer you to an attorney and an accountant, a financial advisor, before you make an investment if you want to get guidance in those areas. Now, we do talk about legal and tax and investment issues through the course of our webinars and seminars that we do. But please keep in mind, just it's up to you to do your due diligence on the investment, anybody that you're dealing with, and make sure that you're comfortable with that particular investment. Now, just a little bit about Advanta IRA and who we are and where we've come from. We've been in the industry of self-directed IRAs for a long time, and we use we use a lot of banks that all the cash that you hold in your IRA is FDIC protected. We're currently close to $1 billion in assets under management, but really the great thing about what we do at Advanta IRA and how we set ourselves apart is really our customer service and being able to give individuals a much more personalized treatment when it comes to their self-directed IRA accounts and giving out one-on-one concierge service. We do that through our account manager system, which I'll detail here again in just a moment. One way we try to differentiate ourselves within the IRA world and the self-directed IRA capacity is really through our learning center and what we do on an educational basis. We try to provide as many webinars and seminars as we can and events really to help individuals get as learned and as educated as possible, not only about self-directed IRAs, but different things they may be investing in. That's why we've invited Charles on today to talk about tax liens. It's something that I don't personally have a whole lot of knowledge on tax liens other than what I've picked up over the years. We've had attorneys come on and talk about the foreclosure process or setting up LLCs. So we like to bring in outside parties really to educate. And again, that's really what our commitment is at Advanta, to educating you about, again, not only self-directed IRAs, but what you're looking at doing. And we do that through our webinars, our seminars, lunch and learn events that we have. And we have all of our recorded webinars on our on-demand channel on YouTube as well. Now, kind of how we're different from what other custodians do. Again, I think the two biggest differences we have between us and other custodians is really in our customer service and our educational offerings. I just mentioned all the different workshops and free webinars that we do, seminars, bringing in guests. Some companies, they just do a monthly workshop, and it might be in some location that's not close to you, and they want you to pay for it and come to the seminar. We do all of our education free. And again, on our customer service aspect, you call into some custodians, you're calling into an 800 number. You're getting a different person on the line each time you call who's having to research your account in order to answer perhaps a very simple question for you. At Advanta, we set you up with a dedicated account manager, one person who will be your point of contact if you have any question regarding your account, whether it's your account balance, the status of a transaction or a transfer. You have their direct contact information in order to get what you need regarding your account. Some custodians only offer one option for annual fees. We have two, and kind of go over that on an individual basis. But we let you switch between the two and figure out which option is going to be best for you. As far as the people, I can't speak to really what other custodians and the quality of individuals they have. I'm sure there are many of them out there. I can only tell you that at Advanta IRA, we do a lot of professional continuing education, and we have a number of individuals in our office who hold the designation of a CISP, a Certified IRA Services Professional. Myself and our owner, Jack Callahan, are also attorneys, and we have a lot of individuals who work with in accounting and financial backgrounds that comprise our staff. So kind of those of you on the call, maybe some of you on the call today who are really not familiar with self-directed IRAs, I want to cover that just very briefly. Self-direction simply means that the owner of an IRA account, if you have a self-directed IRA, it means you're in control of what you want to invest in. You're not going to be pigeonholed by a bank, by a mutual fund company, a brokerage house. It's going to limit you to investing in those assets that they promote and that they sell. That's their business model. That's not ours. Ours is to allow you to invest in kind of a lot of the alternative assets. And again, we're talking today about tax liens. That's just one small segment of all the different investments that you can hold. You can hold different types of real estate, mortgages and notes, private placements. We have people investing in foreign currency. There's been some interest lately in people wanting to invest in cryptocurrency. So self-directed simply means that you have the ability to make investments that you want to make and not being, again, limited by what your custodian is offering you. And people who choose to self-direct oftentimes do it for maybe a few different reasons, and these are kind of the three main reasons we've seen over the years. Individuals simply who have their IRA comprises a different source of capital to invest in assets they are already familiar with. So using today as an example, if you were already investing in tax liens on a personal basis, the IRA simply provides you another source of additional funds to buy more tax liens. Other reasons, an individual wants to have their gains be tax deferred. So the returns to an IRA, in most cases, all the returns coming back, your profits, your interest income comes back into the IRA on a tax deferred or possibly tax-free basis if you have a Roth account. And so the investment returns are not affecting your personal taxes. And third, and certainly not last, but a lot of individuals are certainly frustrated, scared, worried, can't sleep at night because of the stock market. Now, we saw a lot of wild fluctuations recently. Some people think that that's a rigged game. The stock market is. Whether or not that's the case, individuals want to be in control and not being subject to the whims of a market they have no control over. So, again, people use self-directed IRAs for a variety of reasons, but these three are typically the most common. Now, as far as what accounts can be self-directed, any type of IRA, your traditional, your Roth account, a SEP IRA or a simple IRA if you're self-employed or own a small business. Individual 401k plans for people who are sole proprietors offer you a great ability to make larger contributions on an annual basis into a solo or individual 401k plan. Certainly any former employer's plan. So if you have an old 401k, an old 403b, an old 457 plan from a previous employer, you can roll that money into an IRA and begin self-directing immediately. So for more information on these types of accounts, I would encourage you just to give me a call. I can walk you through the differences between the different accounts and what you may or may not qualify for. Now, if you already have money in one of those accounts and you want to say, how do I self-direct? How do I get that process started? It's very simple. It's either doing a transfer or a direct rollover from that other account into the self-directed IRA that you set up with Advanta. So you fill out our paperwork to open up an account, and then we send a transfer request to your other IRA custodian to move cash or assets. Or you can contact your former employer plan and ask them to do a direct rollover into the Advanta IRA. Now, most transfers, rollovers happen within 1 to 2 weeks. Sometimes it's a little bit longer depending on each different custodian. But the key thing is transferring and doing direct rollovers can be done an unlimited amount of times. It can be done in partial amounts. And when you move funds via a transfer or direct rollover, there are no tax consequences whatsoever. Now, again, in self-directed IRAs, I mentioned there are a number of different assets. And again, this list, although trying to be somewhat comprehensive, still does not encompass everything that can be invested in a self-directed IRA. But we see people investing into real estate, whether that's a rental property, whether it's a rehab or a flip. People investing in multifamily projects. You can invest, that's those situations where your IRA is owning and holding title to a physical piece of real estate, actual brick and mortar building or even raw land and the dirt that's on there. We see people invest in private notes and mortgages, having your IRA stand in the place of a bank and do lending out of your IRA account. You can invest in private placements, whether that's private stock, subscriptions to private partnerships or private equity partnerships. You can invest in mobile homes, parks, LLCs, gold, silver. Again, the list goes on, and of course includes tax liens, which we're going to talk about primarily today, and we bring on Charles here in just a moment. The common thread with all of these assets is simply that the brokerage firms that most individuals have their IRA, they have their 401k with, they're not willing to hold those assets. Okay, there again, their business decision is deciding that they don't want to hold it. IRS rules certainly permit this investment within an IRA account. They just have made the business decision to not hold it. We, of course, have made the business decision to hold that particular asset. So what does it look like for investing into tax liens using your IRA account? Now, before we go into the actual case study, I want to talk about a strategy that we see a lot of individuals use for a number of assets, but it works especially well, I think, a lot of times within tax liens, and that's getting what they call checkbook control over your IRA account. So rather than having Advanta hold all of your cash and hold all of your investments and do all the record keeping, a checkbook control would allow you to place your assets, place your cash into an entity and into a bank account that you can control. And you basically have the ability to purchase investments, write checks for expenses, et cetera, manage all of that underneath one structure. And it's typically achieved by creating an entity, usually it's an LLC, in which your IRA account is the 100% owner or member of that particular LLC. So it's a brand new LLC, never been owned by anyone before. Your IRA is the sole member and sole owner. Your IRA contributes cash into the LLC, and then you name yourselves as manager, because you're a physical person, you need somebody to actually physically sign checks or sign documents. You name yourself personally as manager of that LLC. So you would instruct Advanta to send cash into an LLC bank account that you've established, and you now as manager can make your investments, again, writing the checks to fund investments, whether you're buying a $250,000 rental property or whether you're buying a $2,000 tax lien. You can invest in all of those assets inside this one particular structure. Now, when we're talking about tax liens and investing in multiple counties and in multiple amounts, this definitely can have an advantage, and we'll go through a case study to illustrate why. So this case study, we have John. He has $100,000 in an IRA account, wants to buy tax liens. So he sets up his Advanta account, again, filling out our paperwork, requesting a transfer from his current custodian to transfer that money directly into the Advanta IRA. Now, John, again, is looking at buying tax liens in a lot of different counties, and a lot of administrators may charge fees based on how many different assets you're holding, or you're dealing with a lot of counties. It can be a lot to keep track of, and you can certainly incur a lot of fees when you're buying in several different counties. Even if you're only buying $5,000 here or $10,000 there, that can get a little expensive depending on how you're looking to do it. So John thinks, hey, a checkbook control entity will probably give me some flexibility and obviously going to reduce the fees that I might be charged by my administrator. So he forms an LLC. He titles it Savvy Real Estate Investor Association LLC, Savvy RIA LLC. Again, names himself as manager of the LLC, and then as manager of the LLC, he will get a bank account established in the name of Savvy RIA Investor LLC. He will then direct Advanta to send that $100,000 from the IRA account into his LLC bank account. And again, as manager, he will disperse the funds from the LLC bank account to purchase various tax liens. And he's only going to incur one administrative fee from Advanta and going to pay a flat annual fee going forward. So even if he is buying tax liens in different states and different counties, he isn't going to have any more additional fees from Advanta for holding that particular asset. I had a good question pop up here before we go into the execution. Somebody said, are there particular requirements for the bank account setup for the LLC? Not particularly. I would recommend, if you were setting up a checkbook control LLC, to simply, when you go to the bank, you would take to them the articles of organization for your LLC that shows you as a manager. and simply take the tax ID number and just ask for a basic checking account in the name of the LLC. It doesn't, you don't want to necessarily mention it's an IRA or cause any other hiccups, just a basic checking account for the LLC. So John's done that. He set up the bank account. When he's ready to buy the tax liens, he decides what he wants to purchase. And again, when he purchases the tax liens, or if he opens up an account in a particular county to buy tax liens, that all should be titled in the name of his LLC. And then John, again, as manager of the LLC, can issue a cashier's check or a wire from the LLC to purchase the tax liens that he has bid on. So he, again, has that checkbook control to issue funds out of his particular account. Now, as the tax liens pay off, the funds will simply go back into his LLC bank account. He can use that cash coming back in to buy more tax liens and invest in a whole variety of other types of assets. Ultimately, if a tax lien goes unpaid, John, again, as manager of the LLC, is going to take the steps to redeem the tax lien and then place that property back inside of the LLC. And again, same thing again, future profits from that property will go back to the LLC. So he has that control within the checkbook for his IRA account. All that being said, if you don't think that a checkbook control is right for you, or you still want to have the direct purchases from your IRA into a particular county, we can certainly still work with you. We've done it with several individuals over the years. Just always, a lot of times depends on the county in which you're buying and their particular process. So I had a couple more questions come in before I'm going to turn over to Charles here in just a moment, but I'll answer these questions and would encourage you to keep sending them in. Can there be multiple managers? Yes, you can have multiple managers for the LLC. It's just up to you when you talk to a bank or people that you do business with, if they're going to require both signatures from the manager or all the signatures from the managers on one particular document. But you certainly can have multiple managers. Can this LLC do ACH transfers? Certainly. I think if you set up your bank account in the name of the LLC, you should be able to do ACH transfers directly from your LLC bank account to those counties to purchase tax liens. I know that when we have purchased tax liens for some of our clients where they have not used an LLC, we can certainly also accommodate the purchase of the tax liens via ACH as well. Question is, does having the bank account interfere with the arm's length distance we need to maintain for the IRA account? A great question. The Checkbook LLC has been around since probably the mid and late 90s. It has been tested on a couple of occasions. The IRS has challenged the validity of an individual having that type of control over their IRA account inside an LLC. The tax court in both cases has said that being the manager of an LLC that your IRA funds that invested in is not a prohibited transaction per se. Now, certainly if you're in control of those funds in the LLC, you need to make sure to follow other IRA rules. You still can't engage in prohibited transactions. You can't pay yourself. You can't take a salary. You can't commingle your personal money into that particular account as well. There are certainly some things to be aware of, but as far as violating the direct arm's length option, that's been decided not been an issue. Another question, heard the checkbook IRA could also be done through a trust instead of an LLC. Do we have that option? The answer is yes. If you want to get checkbook control by using a trust and having your IRA own a trust, that is possible. However, I just mentioned all the court cases that support the checkbook control LLC for an IRA. There is not similar court cases for a checkbook control trust, meaning that we do not permit an individual to act as trustee of their checkbook control trust for their IRA, and do require you to get a third party because there's not the same case law that stands behind that. So just keep that in mind, but you can use a trust if you have a third party who can act in that position. You can certainly do this by doing a trust as well. Another good question. What are the implications from paying the manager of an LLC in which the IRA LLC is invested? Again, you can't pay yourself, but if you have a third party, someone unrelated to you acting as the manager of the LLC, and you're paying them a small amount for the management of that account, I don't think that's an issue. Can the LLC be held in a trust? Yes, you could have your LLC managed in a trust. Another question, using the funds from the IRA, deposit the funds into an LLC, then buy tax liens without being taxed. Yeah, that's exactly what we're talking about doing. So I'm going to move on now. We'll continue the questions coming in. We'll get to those as we typically go through the presentation. I'll bookmark a couple of these questions and come back to them. But I do want to give Charles plenty of time to kind of go through his slides. We're joined now by Charles Sells, who is the founder and managing director of the PIP Group. He started the company back in 2004 with just a couple $1,000s and a couple of investors to start investing in tax liens. So Charles is going to go through with us, say a lot of the basics of tax liens. So if you have questions, please get those typed in the chat box. Charles, are you there today?
I am. Thanks so much, and thanks for that great presentation on self-direct IRAs as well. As our investors, I see a lot of our investors are on this call. With the PIP Group, we have probably 200-something self-direct IRA clients with various custodians, and something that you guys are very unique with is that individual point of contact, which makes all of our lives better. And you know, you didn't use the term, but I know the term is out there, is concierge level, if you will, and that's exactly what you guys do. You know, so I want to stress to our investors that you know, that type of custodian has, you know, multitude of benefits for our investors as well. You know, so just to stress that out there, I definitely would say, you know, reach out to Scott and get a more intimate details of the differences between who your current custodian is and who Advent is. So with that, we'll discuss very quickly why investors love Illinois and Georgia. This is very basics of tax lien investing, and it's a lot of slides. And again, I want to dedicate a lot of time to Advanta today with this co-host presentation, and so we'll cover Illinois and Georgia, and I'm also going to cover a little bit of Florida. So let's get going here. Scott has already mentioned who we are and what we do, and it seems my slides have now frozen on me. Scott, they don't seem to be advancing the way they're supposed to.
There, Charles, I don't know if your computer froze. I was able to advance. I can advance them for you if you're having trouble.
Okay, yeah, I'm going to skip 17. Yeah, I've lost the network connection. So if you can, I'm actually out of town right now, and of course this is just typical. So let's skip 17, which is just essentially an introduction of me. We already know who I am and what it is I'm doing. And as I'm speaking here, it looks like the connection has come back online.
There you go.
All right. So distressed real estate is not sexy. Something I always stress with our investors, new and old, is that we are talking today about tax liens. However, we cover everything in the distressed real estate umbrella, if you will. We started out in tax liens. As Scott mentioned, I started out when I was 23 with $4,000 and 4 clients. We're now over a $25 million company, and you know, through revolving investments and resale and liquidity, we're doing about $50 million a year in distressed real estate. So we started in tax liens. Tax liens brings in tax deeds. Tax deeds creates fix and flips. Fix and flips or other acquisitions creates cash flow investments, and so on. So that's essentially what we've been doing. Something I always like to stress is to not believe the hype. Everyone's heard of tax liens, and a lot of these folks, I imagine, have even, you know, spent as much as we've heard recently, as much as $60,000 for a 3-day coaching course on how to invest in tax liens. And these are comments I've actually taken directly from some of those you know, hype pictures that you see on late night infomercials still to this day. Earning 8% to 25% government guaranteed, or receiving a free and clear tax deed. There's so many things wrong with just that statement. A tax deed is not free and clear. A free and clear title, as many of you know, is a warrantable title. In some states, yes, that is what you get. In most states, that's not the case. Turning $20,000 into $20 million in 1 year. Not going to happen, impossible. Yes, tax liens offer a great investment opportunity, but you're not going to make those kind of returns. Buying a beachfront property in Florida for $500 at a tax sale. You may buy a piece of a lien at the tax sale for that particular property, but there's a whole lot of other things that go on behind the scenes that we'll get into real quickly. And I'd like to stress I am going to blow through these slides very quickly to stay on time, but if you want a more detailed recording of this, you can visit our website, or we'll do more comprehensive webinars in the future with Advanta as well. So inside the mind of a tax buyer coaching program, they make it sound so simple. You buy a tax lien, you process the redemptions, you consider secondary markets if you don't want to foreclose, then you initiate foreclosures, you have a DREO, i.e. the tax deed, you go through quiet title action, you list it with an agent, and you eventually have the resale. Inside the mind of an actual tax buyer, there's a lot of other things going on behind the scenes. You're processing redemptions, you're considering secondary market, you're deciding whether you should pay the sub-taxes, should you go ahead and do another audit, because a lot of things can happen. There's a lot of behind-the-scenes activity that's actually involved to get this great return. Obviously, work hard, do well. Same applies for tax lien investments. Yes, there's a lot of opportunity, but there's a lot involved in the process as well. So I know Advanta home offices are in Tampa, Florida, I believe. So I did want, in this presentation, to address the elephant in the room, if you will, which is Florida tax sales and how they work. It's probably the most complicated state in the entire country because they have two types of sales, tax lien sales and tax deed sales. Now, you're going to find some typos in my text here, but I'll just so you know, I've ripped all this information from the Pinellas County website. So I will give them a heads up in a few days that they've got some typos in their notification process of how this process works. So the tax collector is required by law to hold a tax certificate sale on or before June 1st of each year. The sale for Pinellas County is going to be held on or before June 1st, 2018. I believe they've actually confirmed that it will be June 1st of 2018. The sales is conducted in a reverse auction style with participants bidding downward on interest rates starting at 18%. That sounds great. The certificate is awarded to the bidder who pays the taxes, interest, and costs and accept the lowest rate of interest. And that's going to become really important in just a second. Bidding begins at 18%, the maximum bid rate, and bids down in increments. Each certificate is sold individually to the bidder offering the lowest interest rate. Now, I've got in bold here, in the case of a tie at the lowest rate, the winner will be selected using the random number generator in the auction software. So, Florida auctions, 99% of them are online. What that means is bidders can register multiple times. And a few years ago when they first went online, we found that in one county, one particular investment company out of Asia had actually registered for the tax sale 50,000 times to essentially create a lottery-type atmosphere where they were going to get the majority of the bids. For all certificates except for those bid at 0% or issued and redeemed in May, the minimum interest you will get at the time of redemption will be 5%, so that's a penalty, even if the interest earned to date is less. So essentially what that means is you're going to get 5% plus 1.08% per month for the next 2 years. Again, sounds great. If a certificate gets canceled or reduced, the interest earned will be 8% per year, simple interest. So that's prorated, so that becomes less than 1% per month. On a canceled or reduced certificate. So I mentioned that Florida is very complicated. So in most states, when you go to a tax sale, you buy the taxes, you wait a certain period of time for redemption to occur. If the redemption doesn't occur, then you initiate foreclosure process, and essentially you go through judicial processes, and you wind up with the deed. In Florida, you actually have to go through a double sale process, if you will. So the holder of a tax lien certificate, after 2 years, since April of the issuance of the tax deed, can file a certificate and an application for tax deed. So the short term, we call this as a TDA, tax deed application. Certificate holder makes application for the tax deed and pays at the time all applicable amounts to redeem all other subsequent and prior taxes, the interest on those taxes, any omitted taxes that didn't come up, plus the interest, delinquent taxes, more interest, current taxes, et cetera, et cetera. So you're paying all of the delinquencies essentially off, and you're earning something on those as it goes through the TDA process. If applicable, if you don't pay those taxes within 30 days, then the property essentially lands on a list entitled lands available for taxes, which becomes a whole other set of circumstances and processes. After all necessary advertising and noticing, the clerk's office will schedule a tax deed sale. The tax deed applicant, that's you, receives 18% per annum interest on the application beginning the month after the application through the month of redemption or tax deed sale. So we've paid up all these TDA costs, past and subsequent taxes, and any other fees, and you're potentially now earning 18% on those as you're going to auction. But you have to go to auction and essentially be the winning bidder, if you will, or have nobody else bid on your tax deed application. So there's big but, obviously, for all those great fees. So we're going to discuss the big but. Florida represents 30% of all tax liens sold nationally. I actually just learned this probably about 5 years ago. I didn't realize that they represented such a large amount of the tax lien portfolio that's out there. And 90% of all institutional tax buyers focus their attention in Florida because there's so much volume for them to buy. I mentioned that 5% penalty that you get when it's redeemed right away. So that's essentially what they're going for. So what happens is they're bidding down the liens to next to nothing. The max bid rates at auction average 0.25%. Yes, that is not a typo. That's 0.25% is what they're bidding at. And many are buying them at zero. In the state of Illinois, we watched a hedge fund over the last 2.5 years spend close to $30 million per year at 0%. And the big question is why? There's two questions. One, they're leveraging on the hopes of getting that 5% penalty in Florida. And two, in Illinois, they were leveraging on the hopes of buying the subsequent taxes, which pays 12% per year. So heck of a risk, heck of a gamble if you ask me, but that's essentially what they were doing. If you are willing to accept such a low bid, your odds of winning are still less than 1 in 250, and it's probably actually higher than that. Now, I'm not talking about every single county in the state of Florida, the majority of them. So there are going to be some break-off counties where your odds are going to be better because the hedge funds or the institutional buyers are not interested in those counties because there's not enough volume of tax liens being sold. So to summarize up the state of Florida, I say stay out of tax liens, but explore tax deed sales. If you're wanting to buy in Florida and you want to acquire the property, then Florida is a good state. If you're wanting to buy and have high penalty and interest in redemptions, Florida is definitely not a good state to be investing in. So that's the big elephant in the room, if you will, on Florida.
Hey, Charles, if I can, I'll just ask you a couple quick questions, and I would encourage anyone who's got some more to add them. But one of them was you said that there are 30% of all tax liens in the nation come from Florida. Have you done any research or know why that's the case? Is it the only thing I'm wondering is if there's a high number of homes that are owned free and clear without any mortgage, where a bank is escrowing property taxes, or is that not really a factor?
Right, no, and that's a great question, and I did not explore. It was brought up at an organization which is called the National Tax Lien Association, and it was just brought up to me in common conversation from a very large tax buyer who only buys in the state of Florida. My assumption would be that there's Florida is obviously a huge retiree state. There's a lot of paid off homes, if you will. So a lot more taxes do slip through the system. But Florida also taxes everything. They tax, sewage drainage. They tax light posts. So that obviously adds up the number as well. But to answer your question, they did all the data. I didn't ask. My answer was, that's interesting. So the number stuck with me, but because we don't invest in Florida, I haven't done any of our own data research to find out why.
Another quick question, and kind of because we're talking about Florida, I know you're going to move on to Illinois and also talk about Georgia as well. Someone just asked what's the best sources of info for the state of California, and maybe not California specifically if you don't know that answer, but what is you said the National Tax Lien Association, or is there any kind of website people can go to kind of consult information on other states too?
I would start there with the I believe it's ntla.org. I would start there. They have a good amount of resources. California is definitely, we invest in what we call investor friendly states. California is definitely not one of those states. So we stay out of it. I was just in San Jose last week. And obviously, real estate is what I live and breathe. And I was looking at home prices in San Jose, California, how they had risen 18.5% in 2017. And that's just, that's a market, it's like it reminds me of NASDAQ of the late 90s. We all knew that those prices were blown up, but everyone was trying to take a bite out of it before the bottom fell out. That's essentially California real estate as a whole, as far as we're concerned, and it's not investor friendly. But yes, the short answer to the question: start with ntla.org, and that will lead you into more directions, and you can look into investments in that your particular state that you're interested in.
Okay, yeah. Again, encourage people to keep asking the questions, and I guess Charles, go ahead. We'll keep going.
Yep, and I'm gonna try and go very quickly with this because I still have a lot of slides. Again, if you want more information, more comprehensive webinars, by all means, just reach out to either of us, and we'll either get those scheduled or we'll get them on our website so we can speak more comprehensively about this. So very quickly, what are tax liens? They're a reliable and predictable source of revenue for local government. What happens is the government, if they don't collect on their budget, they can't pay their firemen, they can't pay their police, they can't pay their teachers. So they sell these taxes, these property taxes, to buyers like us at tax sales. To make it advantageous for buyers like us, interest rates and terms are usually pretty hefty. We talked about Florida having, a max bid rate of 18%. Even a 5% penalty is pretty good if you can get that annualized in the first. While we invest in investor-friendly states. Once you buy those tax liens, the delinquent owner then has a time determined by local law, that's going to be state law, to repay the debt. And we're going to do a quick comparison of Georgia and Illinois, how they work very differently and have very different outcomes based on how their laws work. I've lost the. Nope. Okay. All right. So the process is very simple. The taxes become delinquent. They're advertised for sale, and they go to public auction. As I just mentioned, there's a redemption and maturation period, which is set by the state. Redemption essentially is how long they have to redeem the taxes, pay off the taxes and penalties and interest. The maturation is when the liens mature and you've earned the right to foreclose on the property. Then you initiate the foreclosure and the quiet title action if necessary for the state that you're investing in. Big question that always comes up at this stage is, okay, what about first mortgages? First mortgages and typical traditional homes and commercial properties fall into tax sales all the time. It just slips through the crack, whether the taxes are escrowed into your mortgage or not. So a super lien is essentially, a property tax lien is essentially a super lien, and there's a few super liens out there: IRS, property taxes, code enforcement, condo and HOA liens. So essentially what this is it's better or stronger than the first mortgage or second mortgage on the property. They have the right to redeem the taxes just like the homeowner does. If they fail to do so, you're foreclosing on the right to redeem, or you're foreclosing on the property, on the mortgage company, as well as the homeowner. So we define tax lien investors into two different categories, and I kind of touched on it when we were looking at Florida when I said it's great if you're looking for property, not so great if you're looking for interest. So we divide investors into redemption investors and property investors. And as we do this comparison on Illinois and Georgia, you'll see the contrast differences. Redemption investors want to invest in states like Illinois that have huge interest rates that compound and have high penalties for redeemed liens, and the likelihood of redemption is better because they're out there longer. The redemption in Illinois is 2.5 years. Property investors, they actually want the property, and this actually represents about 60% of all tax-distressed investors. They want the property. Those coaching programs that are out there have pitched the concept of getting the property for, they use the term pennies on the dollar. I don't use that term because you're actually going to be closer to 50, 60 cents on the dollar. There are some great home runs out there, but typically 50 cents on the dollar is what you're going to acquire property for. So those investors focus on tax law aggressive states, if you will, Georgia, Texas, South Carolina, or they go into secondary market acquisitions and pre-deed acquisitions. So let's talk about Illinois very quickly. Redemption. State legislation in all states regulates the amount of time a taxpayer has to redeem. In Illinois, it's 2 to 2.5 years. However, a tax buyer has the right to extend that to 3 years from the date of purchase. Because our investors are buying in Illinois for the redemption, they are essentially categorized as that type of investor. We automatically extend the redemption right to 3 years because we want to foreclose in Illinois on as few as possible. In Illinois, we have to petition for the deed prior to the expiration of the right of redemption. So that's going to vary very differently to what Georgia offers. In Illinois, again, why redemption investors like it so much, the maximum bid rates are 18%. So when you go to the sale, if you have a $1,000 tax lien, you're buying that tax lien for $1,000. If you won the bid at 18%, the next day, if the homeowner redeems, they owe you $1,180. So that's how you're bidding at the auction. What makes Illinois so unique and so attractive to our redemption investors is that the bid rate increases every 6 months. So if, let's say you went to the sale and the maximum bid was 18%, but you actually acquired it at 10. At 6 months and 1 day, that 10% becomes 20%. At 12 months and 1 day, that 20% becomes 30%, and so on. So you could actually end up having a redemption at that 3-year period of, if you bought it at the max rate, of 108% penalty. So again, unlike Florida, it's not annual. It's not prorated throughout the year. You're getting it the next day. So that's what makes Illinois very unique. This is just very quickly a certificate of what you receive from the county after a tax sale. It's a fairly official looking document. You've got to have this in order to initiate the foreclosure. And essentially what it spells out is the county it was purchased in, who owns it currently, the property tax code. I can look at this and see that it's improved residential property, and the amount of taxes that was paid for, and the penalty rate we acquired it for. So this slide just illustrates, excuse me, very quickly, and it's a little fuzzy, how the compounding factor works. So the purchase date on all of these was on October 27th of 2017. They were all redeemed within 2 months at 18% in penalties. So if you can blow that up on your screen, you'll see what that penalty amount is. They call it interest. We call it penalty because it's paid the next day. Again, so it's not prorated throughout the year. This again just shows how that compounding factor works. If you look at the top one, we see it was acquired at 16% at the tax sale, and the one below it was acquired at 18%, and you have that compounding rate in the 18% becomes 36, and 36 becomes 54, and 54 becomes 72. Again, this is just another certificate that kind of outlines that 18%, the clerk's fees that are tied into it that are paid by the homeowner, the buyer notice fee, which is something we won't cover in this presentation, but it's a lot of the behind-the-scenes stuff that I mentioned to you that has to be taken care of at certain times within the investment. So talking about tax deeds very quickly. As the name suggests, tax deeds are what you get from the default judgment of unpaid property taxes. As I mentioned, in some states it's very quick, it's very easy. When we look at Florida, it's an entirely different auction with more investments, different rates of interest. So it's going to vary state to state. And it's going to vary with regards to what you get. In Florida, you get a tax deed, but you still have to go through a quiet title action. In Illinois, it's a tax deed, but it's already been through quiet title action. So every state is different. Depending on the state that you're wanting to invest in, you need to know exactly what you're getting when you get that deed. Some states call it a tax deed. Others call it a title of conveyance. Some call it just a tax title. It's all essentially the same thing. It's just what kind of marketability or red tape is still attached to it when you acquire it. So this essentially just shows you clean living. This is an investment that went all the way through the tax lien purchase, all the way through the foreclosure process. You can see that the market value of the property was $80,000. The lien cost, the rate we acquired it for, the potential foreclosure fees involved, the back taxes that you're going to have to pay. And so you have to assume you bought year one, and then years 2 and 3 were sold at tax sale again. And at that point, you initiated foreclosure, so you've essentially going to have to pay all those back taxes for a total investment of $10,033. And let's just assume you sold it for 50% of the market value. So that's going to be $40,386.50, and that's where you get those good profits. But there's a lot involved behind the scenes to get there. So this is just an example of one through the Illinois process. In the state of Illinois, we invest. Yep.
If I can interrupt, because we had a question come up. I think kind of it was you addressed a little bit on that last slide, but someone asked, what about IRS liens? They're in front of property tax, but more so, it says some counties allow multiple tax liens on one property in the form of previous lien years, previous year's liens. Which lien has the right to foreclose? And I think you're just showing on that slide how there's other back taxes. Is that if you can go through that process when there's maybe multiple liens on a property when you have one of them?
Yep. Okay. So if you bought, let's say you bought 2017 taxes, and again, it depends on the state that you're investing in, how the laws work. In Florida, you could be responsible for prior and subsequent taxes. In Illinois, you're going to be responsible for subsequent taxes. You're not going to have to deal with those priors to the year you bought. So if you bought 17 in the state of Illinois, you don't have to worry about 16, 15, 14. They had the right to foreclose ahead of you. They chose not to for whatever reason. So you essentially just brush them off. The county has collected their money. They're essentially just risking their investment leverage by not foreclosing prior. But again, in Florida, it's different. You are responsible for priors. Arizona, for an example, I know I'm getting a little outside the scope. Arizona can after you go to the sale, you may not see that there's priors. You go to the sale and you buy a tax lien, and all of a sudden 17 years of priors pops up. that they were unable to sell in previous tax sales. They'll hit you with those. So obviously, when it comes to investing in tax distressed real estate, it's all about due diligence. There's a lot of opportunity available in buying tax distressed assets, but it all has to do with due diligence on the front end. One, understanding all the laws and all the loopholes that are involved, but also understanding, how these processes work, what kind of deeds you can get, that sort of thing. To address IRS liens, that always comes up. And if you saw on the super lien slide, yes, it is a super lien. In literally hundreds of thousands of acquisitions we've done and foreclosures we've done, we have run across IRS liens. By law, we have to give them essentially a 180-day notice of our intent to foreclose, and that they have to respond usually within 90 days. But not in one foreclosure have I seen the IRS liens become the responsibility of the tax buyer. They want the person who has the IRS lien. So essentially that lien will come off. It'll go on to something else that homeowner essentially has. But yes, we do have to provide them with a 180-day notice of our intent.
All right, well, go ahead and continue. We'll try to finish up here. We have a couple more questions to get to at the end.
Okay, great. So in Illinois, out of 107 counties, we invest in 97 of those counties. We have a vast network of contractors and employees that enables us to do very well in the states because we're essentially attending these 97 tax sales within a period of 3 months. Between September and, let's call it September 15th and December 15th. We attend 97 sales, many on the exact same day. Next two slides I'm going to skip over just because we don't have time to really discuss it today, but pre-deeds is essentially an investment. It's a different type of tax distress investment where that redemption investor pushes his property through foreclosure but still doesn't want to own the property. There's a lot of reasons for that. It's covered in a completely different presentation that lasts about an hour just in itself. So we can do one of those, Scott, in the future. That covers just pre-deeds. So let's do the comparison on Georgia. Georgia liens are what we call hybrid liens. Somebody came up with the term hybrid probably about the time hybrid cars started coming out, and it's a great term because it's a mix mash of a tax deed sale and a tax lien sale. So the way the process works in Georgia, there is a 1-year right of redemption. In Georgia, you must foreclose the right of redemption 12 months and a day following the purchase of the lien. So in Illinois, you actually have to initiate that process before the redemption period expires. In the state of Georgia, you have to do it after the redemption period expires. So Georgia tax sales are pretty cool because, one, you can essentially manipulate whether you want to be a redemption investor or a property investor. If you do your due diligence and you look at something going into a tax sale and you see there's a mortgage attached to it, you can assume that one just slipped through the cracks, which they always do, and that the odds of it redeeming are going to be very strong, and you're going to make a good return rather quickly. Georgia tax sales, again, unlike Illinois, you're not bidding down on the interest rate. The interest rate is set. It's a penalty of 20% regardless of what your bid is. So if you had a property that was worth $100,000 and the minimum bid on it was $5,000, and you bid it up to $60,000, the total cost to redeem that property would be $72,000, and you would earn 20% on your total investment, not just on that minimum bid. And again, every state's different. We call that overage on the minimum bid a premium bid. Some premium bids, you earn no interest. Some premium bids are forfeited to the county if it redeems. In the state of Georgia, you earn the penalty on the premium bid, and you get the penalty back on the premium bid. So the total cost to redeem in this situation would be a $60,000 investment plus 20%, or $12,000. So that's how you're getting back $72,000 on an investment in Georgia. Now, Georgia is what we categorize as a property investor state because the terms are short, the terms are aggressive, and the odds of taking title are strong. comparatively to Illinois. Sales in Georgia are also every month versus a season of sales. So that essentially wraps me up. I know it was very quick, but again, we can give you more comprehensive information in the future. And Scott, I'll let you address the questions and throw it back to you.
Yeah, great. Charles, it was some great information, like you said, trying to get as much in there in a short period of time. I appreciate it, and we can certainly explore doing one more in-depth on a couple different topics. Just getting to a couple of the questions we had, going back to the LLC, somebody was asking if you could pay a property manager from an LLC if I'm assuming if your IRA is invested in there. The answer is yes, your IRA can pay any third parties for fees, whether it's a property manager, whether it's a contractor, et cetera. Your IRA can certainly pay those. So I hope that answered the question we had there. It's kind of I guess I don't say philosophical question, Charles, but kind of I guess more procedural in a sense. Someone asked, why do counties need to sell tax liens? Why can't they just collect the fees and interest? What factors might make it important to be near in proximity to the state where you're buying liens? Guess being, should you buy liens in states that you're close to, or does it really matter? I know the answer to the first question, but I'll let you take it.
Okay, so
on why counties sell liens in the first place.
Right. So the liens are sold because there's a shortfall in the annual budget. It sounds like a great concept to collect those fees and interests through the county, and in some states they actually do. Laws changed in Michigan it's probably been about 15 years now. They used to have one of the best tax lien sales in the country. They decided that they would collect on the liens themselves and just do a tax deed sale. But it's worked out in some areas. It hasn't worked out in others. So the answer to your question is it's a shortfall on the budget. It's a cash flow problem. They need that cash in. They need it right away, and investors are a way to get that cash right away. So they have the budget to meet the needs of teachers and police officers and firemen, and be able to maintain those budgets, maintain those pensions, and so on. So that's essentially the purpose of it. The other part of the question, proximity. I always say, when it comes to tax-distressed real estate, you do not need to be investing in your backyard. One, it might not be an investor-friendly state, but two, people have been hung up on the idea of investing in their backyard for a long time, and it's an old-fashioned theory. Before technology hit us, and you're able to do all this research online and essentially telecommute your investments, if you will. You should be investing in investor-friendly states, not necessarily your backyard. Yes, there's live auctions. Yes, there's due diligence involved. But if you're investing in Florida for tax lien sales, there's 2,000 other people on there, and as I mentioned at the beginning of the presentation, as many as 50,000 people who are competing for the exact same lien, and the computer software is essentially just going to select somebody out of it anyhow. So, it's not a state that you want to be buying tax liens in if you're an individual investor.
Somebody asked, what is the best place to go to learn about tax liens or the deeds or process? What was that website again that you gave us? I'm going to put it in the chat box here for www.n.
NTLA, I believe it's .org. So it's the National Tax Lien Association. There's good information in there that you don't have to become a member of their association to get. It's a good place to get your feet on the ground. I don't recommend buying a lot of the coaching programs out there, although there's one that's very, very, very comprehensive and has a ton of information. It costs a lot of money, and what ends up happening is you have all this great information, and you realize that, it's not something you can do on the weekend. It's not something you can do after work. That it is a full-time job, and you end up going out there looking for a servicer, which is essentially what we are. But we're not soliciting anything. It's just you can go for the free information. Essentially, is what I'm saying. There's a lot of it out there. Go to your county websites. they provide a lot of information. Florida probably provides the best that I've ever seen. A lot of them like to shy away from the legislation and whatnot, but that's also a resource. Is just get into your state legislation. The internet provides so much that you can just go into the legislation and essentially pull the law, and you'll learn how to read through the legalese to understand the property tax law, and you can gather essentially everything you need from the legislative information that's in each state.
All right, one more quick question. I'm thinking of the answer to this, but is there any restriction on being involved or investing in both tax liens and tax deeds? I'm assuming no?
No restrictions at all.
Okay. It says that somebody asked about the online bidding process. Do you get to see other bids and respond accordingly, or is it more of like a blind auction typically online?
It's a blind auction online. So states do it differently. There's primarily one online tax lien auctioneer, if you will, and their software does it individually, and they also do it in batches. And what a batch is essentially is you have to buy the whole kit and caboodle. So they might put 30 liens in there, and you may only want 2 of them, but you have to buy all of them at the lowest rate possible. So you're not going to see those bids in either circumstance. However, now there are auction houses who offload secondary market tax liens, which again is not something we can cover in this presentation. But yes, in those auctions, you can see the bids. Those auctions usually last a couple of days, so it almost works like an eBay auction. You see the bids, and then you're pinged when somebody else offers a lower bid. You go in and put in your next bid, and so on. But that's only on secondary market tax liens.
Last question, and we'll wrap up the webinar. Was someone asked, what is your opinion on OTC liens? Are they worth the effort looking into?
Okay, over-the-counter liens, and great question. I personally say absolutely not. So at a typical tax sale, you've got buyers like the PIP Group and other hedge funds who have gone out and done extensive amounts of research and due diligence prior to that auction. If it didn't sell in the auction, by all of these other folks who have done all this research, there's definitely a reason for it. There are some buyers out there who are willing to take greater risks, and they'll buy what we call half parcels. It's not necessarily a half parcel, but it's a parcel of land that you can buy over the counter, but the garage of the homeowner is sitting on that particular parcel, and his house is on another parcel. To us, that's essentially just getting into bed with a bigger problem if it doesn't redeem. So you have to be very careful with over-the-counter liens. You may find a diamond in the rough, but even if you do find that diamond in the rough, it's gonna have some issues attached to it that you're gonna have to be creative with, if you will, if you end up acquiring the deed to that property.
All right, great answers, Charles. Thank you very much for your time again today. Hopefully we'll have you on again soon. If you have more questions about Advance IRA and what we do, my contact information is here on this last slide again. I'll be happy to, if you already have a self-directed IRA, you're looking for either a new custodian, or if you're someone who's just kind of new to self-direction and looking to find out more about it, please contact me here. Charles, what's the best way for someone to get in touch with you?
Best way to get in touch with us is go to our website, pipgroup.com. You can get a lot of information, free information on some of the other things we do, but also to contact us directly. You get in there, we've got a chat box. The chat box automatically goes to a few people in our office, but also copies me. So I'll see any inquiries that come through there as well, and I can answer any other questions that come up after this presentation as well.
All right. Well, Charles, thank you again for your time. And anyone who is listening live, we will be sending out the recording. And hopefully if you're listening to the recording, again, please contact either Charles or myself with any additional questions. So, Charles, thanks again.
All right. Great. Thanks, Scott. Appreciate it.